it's the company that pioneered the upcountry regions. It's the company that keeps challenging its status quo through transforming business models and innovation. Well, I'm talking about global, the king of northeastern regions in terms of construction materials and home improvement products, resonating in its 10-year revenue CAGR of around 10% and with an immense profit CAGR of around 25%. Across its 80 home centers across Thailand and 30 home centers across ASEAN. But its competitive landscape of being the first mover in northeastern regions and being the innovators last, well, let's see an exchanging business landscape. Firstly, although the macroeconomics are turning into a more favorable ways to global, the domestic competition remains a key concern. Therefore, we initiate a whole recommendation on global with a target price of 16.04 Thai baht, representing a 1.5% upside with three key main reasons. First, there's growth potentials, opportunities available to global. Second, there's cost strategy yet to fully unlock the value to global, despite some external factors that might neutralize the effects. And thirdly, international expansion opportunity despite domestic intensifying competitions. Well, let's start with our first question. Are there any growth potential for global?
Yes, we also already got in the average per sales, average sales per store, and store expansion strategy. For the average sales per store, we expect that continue to grow based on two dimensions. For the first dimension is farm income, reflecting in customer purchasing power. And the second dimension is consumption material index, reflecting increasing supply. And moreover, we expect that the farm income continue to grow based on two dimensions is the agriculture plant and product in the however area is a key concern in the first half year 20 and 24. So we project that the farm income continue to grow gradually by 1.78%, which is better than consumption material index growth by 40 basis points. And moreover, we still believe global can maintain competitive pricing. With the dividend from the 8 years ago, despite increasing consumption material index growth. And for store expansion, another result of increasing trend in tourism industry. And the past 3 years ago, global has only 31 districts out of 900 districts in China. So we project that the expansion is will create new dimensions for global revenue growth. And now we still believe that the global expansion is would not pose a key concern to global revenue or global financial health given the strong free cash flow to liability ratio.
Well, what about the cost? We see some possible value yet to be unlocked from the current global cost strategies, namely its homeland product strategies, and secondly, its environmental initiative, despite some rising electricity cost concern in the short term. Firstly, we believe that global can propel its GPM to the new high of 28% by 2027, given by the fact that it's focused in house-brand product strategies, and that house-brand products covers around 30 to 40% GPM, 10% higher than non-house-brand products. Moreover, we observe the increment in the house-brand product contribution to revenue of around 1% year-on-year during the past 5 years, along with the growth in the GPM. Secondly, we believe that environmental initiative could save global G&A expenses by around 14% of the average. It is grounded on the fact that we observe a decrease or a fall in the utility expense to G&A expense despite increasing FT rate during the past 5 years. This coinciding with the commencement of the environmental initiative of electricity consumption and water consumption. And this merit is yet to fully realize, given its long-term plan by 2027. Nevertheless, unfortunately, these would be offset by the rising electricity cost concern of around by 10%. The cost saving of 13% will be offset by 10%. Given the current situation where government actually capped their electricity price to a certain level, despite the Electricity Regulatory Commission having some accrued electricity costs to pay. And this might trigger some rise in electricity costs after the first quarter of 2024, diminishing the cost saving to just 3% on average. In short, well, cost of goods sold to improve, OPEX to improve despite being neutralized by short-term external effect.
Well, what about the global competitive landscape? We see a promising revenue upside from the AC region, but intensifying domestic competition may pose profitability constraints for global in the future. Firstly, global expansion strategy secures quick win by targeting countries with similar customer behavior, leveraging resource synergies, and forming a strong partnership. Having successfully executed in the first stage of expansion, Global is now ready to expand to the second stage in the larger country, starting with Indonesia and Philippines. Our projection indicates robust growth rate of 14.34% over the next 5 years. However, industry success has resulted in a surge of competitors. As you can see in the graph, Thai Wasalu, who is global closest competitors, which backed by Central, has demonstrated substantial growth, surpassing Global in sales despite operating with fewer branches. Moreover, competitors also show the better inventory management, and if Thai Wasalu managed to increase its house brand product to match global levels, it could lead to Thai Wasalu reaching global gross profit margin, allowing them to offer more attractive promotions and prices. This factor could pose a potential challenge for global gross profit margin in the future.
Next, what about ESG? Well, Global has made significant strides in environmental responsibility, especially to the widespread installation of solar rooftop in every store, resulting in a remarkable 53% reduction in carbon emission, which is substantially lower than industry peers. However, a challenge persists as Global remains affordable for 0.48 kg per kilowatt. Looking ahead though, Global is fully committed to generate 60% of electricity consumption by 2027 and targeting toward a 0.5% reduction in carbon emission. Next, global social aspect remain neutral with optimal human management in terms of safety and employee training. However, on a positive note, companies' fair remuneration and contribute to an exceptionally high level of employee satisfaction.
Furthermore, Global's ability to persist through the COVID-19 pandemic and outperform both the market and the industry signifies a strongly fortified corporate governance. However, this could be a double-edged sword as almost half the executives and more than 30% of the shareholders are from the founding family. And even though the company board composition remains up to standard, its chairman is not independent, posing a risk of oversight as well as the conflict of interest. So in summary, our team's view on ESG is overall view on ESG, it remains fairly neutral, given there are improvements that certainly can be made across each pillars. But is the market price fully reflected on our thesis? Well, we base our valuations on the discounted cash flow model with 8.87% WACC and 3.27% terminal growth rate. And based on the DCF model along with these assumptions, our team therefore issues a whole recommendation with a target price of 16.04 Thai baht, representing a 1.5% upside from the last price. Additionally, our valuation model further affirms the overall consistency as the target price falls within the range of the valuation. And this is supported furthermore by the sensitivity analysis of the WACC and terminal growth rate on share price. So now that we know more about the share price of Global, next question is there any risk? Our team has identified 4 key risks, but we'll be presenting the 2 most impactful risks to Global. First, the competition risk may arise in both domestic and international market. However, Global could mitigate this with its versatile marketing campaigns and consistent renovations. Second, the electricity risk could lead to a potential change to the target price. However, we could mitigate this as Global is partially covered with its commitment to power more than half of its energy with solar energy. And so, after we have taken 4 key risks into consideration of our multi-title simulation, we arrived to an average price of 15.63 Thai baht, further strengthening the robustness of our whole recommendation. And with the 3 key reasons: growth potential, cost strategy value to be offset, and the intensified competitive landscape. In combination, with the fairly neutral view on ESG and a fairly priced share price. That is so much to risk. Our team therefore issue a whole recommendation on global. Thank you. And if you have any questions, sorry, the floor is open for any questions you may have.
Okay, maybe I will start with what is Thai Vastu strategy in gaining market share from global?
Thai Vastu mainly focus on aggressive expansion of branches. As you can see in the graph, that in the past, like 6 years or further, Thai Vastu has gained a market share from home improvement market industry by expanding. Yeah, they focus solely on expanding, like Blue Home, which they launched their like small branches to compete. And they also competing in the same region as global, which is upcountry region.
So they just compete head to head with global and Blue Home.
Yes.
And what is your assumption on the cost of debt? Because it's quite curious to know why it's just 1.6% below, it's even below the risk-free rate.
Actually, for the cost of that, we rely on the current debt facilities of the globals. They're having like short-term financing and also long-term financing, and it's mostly credit lines offered by the bank. They have no outstanding bonds, and they have no intentions to issue bonds. Therefore, we believe that in the future this would continue this pattern. So we rely on the historical as well as current rates on our global's debt interest rate, and also they are floating interest rate as well, because they are having some low fixed and floating interest rate. So we rely on both the fixed rate established in the past and also floating rate as a expected floating rate from the trading economics and also from Bloomberg to estimate the floating rate for the debt. And then we weighted it on its debt structure and come up with this cost of debt.
Our second argument is that they are trying to manage costs, so could have some improvement in margin.
Yeah.
And in that big argument, we talk about the gross margin will be improved. So I just wonder that the gross margin will be improved because they're trying to cut down costs. Is it what you're saying?
Oh, thank you for the question. For the improving gross profit margin is actually based on the increase in house brand products. They are trying to promote the house brand product, given by the fact that they will be able to control more costs, and the cost is more favorable in terms of the house brand product compared to non-house brand products that you need to pay some margins over these non-house brand products. Therefore, by increasing the promotion, increasing the awareness in its house brand products, it could get the contribution on these products and having a better gross profit margins compared to non-house brand products.
My follow-up question would be, what is the risk come with doing more house brand product?
We also identify this as well. Well, the risk coming with the house brand product would be a higher inventory management, and it could result in an asset being inefficient. Nevertheless, although could you go to the financial analysis and appendix? This one, asset efficiency. Yeah. So basically, global were having the highest DIO and also have the highest CCC as well. This mainly from its its house brand product strategies, and it's also made a commitment to trying to better manage its inventory as well by investing in innovation, investing in the automated ASIS. So they already made a commitment to try to mitigate this risk as well. Yeah. And also some risk with the transportation as well, as around like 30%, right, from its house brand product coming from like China and Vietnam. This could affect their supply chain as well, their lead times as well.
When you make financial projections on the top line and on the operating expenses, can you explain what's the major driver, and or can you tell at this current market price what are the expectations?
So let me clearly clarify your question. So there are two-step questions, right? First, what are the drivers of both the revenue and the cost? And second, what are the market sentiment with the current price?
What is the market pricing in right now? If you say it's same-store sales, do you know how much the market looking at the same store sale level at the current price
Okay.
or and cost as well. Yeah.
Okay. Revenue driver.
Okay, for the revenue driver, here,
Could you please go to the appendix D and revenue schedule?
for the revenue driver, we divide to three dimensions. For the first, Thailand. For Thailand, we projected based on average sales per store and as store for average sales per store with duplication to prediction. With your farm income and consumption material index both. And for the international, with your based on SSG based on Asian GDP growth rate.
And for the cost driver, we separate them into like cost of goods sold and cost of OPEX. For cost of goods sold, we actually based on its TAM and also the historical contribution of the house brand product, and then we just imply it. Yeah. And for OPEX, we mainly base it on both the employee cost and from the electricity cost. Basically, we base OPEX is SG&A, right? For S, it's mainly employee cost according to the management discussion. So we just estimate its employee and also annual employee headcount, also taking into account the rising adjustment on wage rates as well. And for the G&A expense, we mainly based on the utility expense of electricity and water bills from like bottom-up approach. Yeah. And about the market sentiment, with how they factor SSG, right? Yeah. Like we, to be honest, we didn't really deep down into like whether the market views on SSG is how much, but we believe that it is slightly like around above the 0%, just slightly above 0%, I think. Yeah.
What about sales and other things? Does it matter?
Well, I think it's pretty much aligned with us that the cost will be affected mostly from the electricity cost, rising FT rates, and also concerning just raising the employee minimum wages as well. Yeah. And as for the sales, people would mostly focus on like the steel price and expansion strategy.
Okay, but basically, can you put it in a simple term, right? For example, if you think you're looking at the current market valuation with all these analysis, right? How much revenue growth market is factored in at this price right now? Would you have any idea? And based on your assumption, like on the upside and downside case, can you explain the gap? Why you think the upside will be this much and downside will be that much? Can you?
For the market view, to be honest, we didn't work on that much very roughly, yeah? But we just worked on like our bottom-down approach and based on each factors based on our analysis. Yeah. And for upside and downside risk, you could go to the scenario analysis. I think it's the last slide. Scenario analysis and multi-time simulation. Last one. Yeah. Doesn't really quite well. The main leg of the investment risk. And this one, okay. So we just take into account for key main risks, like if it's downside, we full year of El Nino, if it's upside, we neutral year of El Nino, and follow on with this key scenario, and then we factor out by quantifying the factors, what would be the worst case, what would be the best case. But in our opinion, well, based on our multi-trial simulation, we have like around 1,000 trial experiment, and then we do that for around 30 trial simulations. The average of the average price is 15.63. So it's pretty much within the range of the whole recommendation. Yeah. So pretty much equal of the upside and downside risk.
Maybe I will squeeze in a quick one. What is your revenue growth forecast and net profit forecast different from the consensus? How much is different?
Well, like we didn't take the approach in comparing with the market sentiment at all.
And maybe what is how much is the steel mix in the revenue for global?
You mean the steel mix, right?
Yes.
Steel.
all steel construction, steel
revenue.
Steel revenue is about 30%.
And how much is the steel gross profit margin?
Well, like based on our model, we didn't separate it into based on the segment of the products, but based on house brand products and non-house brand products for the projection. And also we do it this way because based on the company visit, they were not hedging the steel anymore. So